So, welcome to class, everyone. I'm so sorry for just making the video. I was somehow strong yesterday, so I couldn't make the video. So now let's continue. So today, like I said, the topic we are going to be considering is supply and demand zones. The supply and demand zones. And I told you that there are various supply and demand zones. Taking you back to the memory lane, taking you back to your secondary school, I said our economics teacher taught us what we know as what? The law of supply and demand. It's a crucial topic that must be taught in your secondary school if you took economics as a course. So when we say supply and demand zones, they are very easy and they are very common. It's what we use in our day-to-day activities as traders. So when we say supply means that there are more sellers in the market than buyers. And when we say demand, it means that there are more buyers in the market than sellers. Let's say a simple analogy. Let's just make a simple analogy. When we say supply, what we meant by this is that let's say we have 10 sellers that are willing to sell, let's say, product A. Product A has 10 sellers but 2 buyers. Product B has 2 sellers but 10 buyers. Which products do you think we have the highest price? We have the highest price. You are going to see that it is actually what? Product B. Why? Because it's only 2 people that are selling this particular product. Only 2 people are selling this particular product, but 10 people are willing to buy that product. 10 people are willing to buy 2 things. What will happen? The price of that particular commodity will go up. So when the demand is more than the supply, the price goes up. But when the supply, too many people are willing to sell the market, but it's only 2 people that are willing to buy. I'm so sorry. What will happen? The price of the market will come down. Why? Because there are no value attached to that particular thing. It means you can get it anywhere. Therefore, the price of that particular commodity will come down because 10 people want to sell. At least out of these 10 people, we'll see like maybe 3 people or 4 people that just want to dispose the product so that it doesn't expire in their shop. Do you understand? So therefore, it will make the price to come down. So you're able to buy that thing at a very cheaper price. So that's that about supply and demand. Same thing in our market, to our financial market. When we say supply zones, it means where sellers are more than the buyers. What will happen? A lot of shorts will be taking place there. So there will be sell. So at supply zones, that's where we sell or short the market. Why at demand zones? At demand zones, what do? We long or buy from there. At supply zone, we sell or short, and at demand zone, we buy or long from there. So when in the layman term, when we say supply zones, these are areas for possible sell-off or possible short. While demand zones means areas for possible buyback or for possible longs. Now, in our financial market, there are various types of supply and demand zones. It's very wide. This topic is very wide, and I can't cover everything and go deeper to explain each and every aspect of these various supply and demand zones in this particular video because it's just going to bore you. and it will be a lengthy video. So therefore, I will try as much as possible to summarize it so that you can grab it once and for all. So that you can grab it once and for all. So when we say supply zones, I say there are many. Why? Because we have different strategies. So different strategies also show us different supply and demand zones. Each strategy, whether you are using SMC, whether you are an SMC trader, or you are an ICT trader, or you are a retail trader, or you are a volume trader, Ichimoku trader, indicator trader, any form of strategy you are using, they all have their own supply and demand zones. So I will be telling you one after the other. I will be taking it one after the other. Then we will not do it once and for all. But the commonest supply and demand zones include the liquidity graph, area of liquidity graphs, area of liquidity voids, order blocks, supply and demand zones, support and resistance, then fib retracement levels, and so on and so forth. So we have a lot of supply and demand zones. So these are just few supply and demand zones, but the commonest supply and demand zone that we have out there. So those are the. So now when we now say traditional support, let's now take it from this word support and demand resistance. I've actually explained what support and resistance is for us. We know what support and resistance is. I say support is that line that we draw that once price gets here, it's what bounces up. Let's say you have something like this. Your chart looks like this. So all this area from here to here to here, where the prices are touching is what we refer to as support. Why that place that the market is touching at the upper side is referred to as resistance. When you are drawing your support and your resistance, make sure that the market actually touches at least 2 or 3 swing points. So make sure that the market touch at least 2 or 3 swing points before you can call it a support or a resistance. Then when you are drawing a support or a resistance as well, make sure that you draw it on a higher time frame. So higher time frame support and resistance are usually they hold and they are stronger than lower time frame support and resistance. So that's by the way. So now support to retail traders refers to as demand zone, while resistance is an example of a supply zone. Do we get it like that? So that's about that. So let me show you on the chart. So this is a trading view. So let me just pick one coin and analyze it. Let's say I pick BTC. So as I pick this BTC, so look at it. Look at my support here. Look at the support line. You see that the market came to this place. Look at the market was coming from here. It dropped, went up, drop, went up, drop, went up. So it has touched this place like 3 times. You understand? But let's still look at it. It still came back to this place to still touch it before it now finally went up. So therefore, that place is an example of a support. That's how to draw support. Now you can see resistance. If you want to draw resistance, let me look for a perfect one that can carry like 2 or 3. Then I would call it the resistance. Understand? So look at this. If I draw my horizontal line, carry my horizontal tool. If I place it here, you see that the market touched the line in this place. We are moving. It touched here too, then came down. Let's go. It touched, then came down. It still touched, then what? Then came down. Do you understand? So those are what we refer to as, before you now finally break it here. You understand? So those are what we refer to as what? As resistance. Do you understand now? So the resistance must touch like what? At least 2 or 3 swing points. When the market touches the place, it's going to come down. When it touches it will come down. So that's that about support and resistance. Then another one that I talked about is what? Order blocks. It's order blocks. There are 2 types of order blocks. We have bullish order block and bearish order block. We have 2 types of order blocks. Bullish order blocks and what? And bearish order block. Bullish order block, we use it to buy. We use it for long or short. So therefore it can be referred to as what? As a supply, as a demand zone. Demand zone. The demand zone is a what? Bullish order block. Now this bullish order block now is a red candle. Red candle before the impulsive green candles. You see, before the impulsive green candles that did break of structure. So that's bullish order block. They are red candles before the impulsive green candles that did break of structure. So that's that about what? About bullish order block. And bullish order blocks are what? Are demand zones. So let me show you example on the chart. Let's say I pick, what should I even pick? Let me pick this. Okay, let me pick Euro USD. I think I have a chart on that one. So look at this Euro USD now. See this Euro USD. You see that. Look at it now. This place, I say order block are what? You see that this particular green candle, when we say break of structure, it means it broke the previous high. Look at this, the market was coming like this before, then it came here and came down. This is the highest. Then this one did not break this one. This place did not break this one. This place did not break this one. But these green candles that now went up actually broke this particular green candle, broke this particular place. So it has broken the high that we have before. Therefore, we refer to it as what? Break of structure. Now, these green candles are impulsive in the sense that, look at it, green, like they are printing hard. So that's what refers to as what? Impulsive candle. So look at the impulsive candle now. So the last candle before the impulsive green candle is refers to as what? Order blocks. So look at it. This is the last red candle before the impulsive move is refers to as what? The bullish order block. So you are going to see that what happened? The market did not touch it. It did not touch it. But later, the market came to what? To come and touch it. You see it. Can you see? The market came into that box that I used to mark the order block, and what? It touched it, and the market went up. Can you see? That's how to trade it. Do you understand now? That's how to trade it. So let me change this one to, so that you can see this thing very well, what I'm talking about. Look at it. You see that the market was coming. The market was coming. The market was coming. Then the market broke this particular high. As it broke this particular high, what happened? With what? Impulsive move. You can see green candles. You can see a lot of green candles that broke this particular place. So we call it what? A break of structure. So as it broke the structure, you will now come and carry the last red candle before the impulsive green candles. So what happened? Let's see what happens. You see that I use rectangle to actually mark that thing. You understand? So what happened? The market came back to that rectangle. Can you see? It went up. So it still came back and went up very well further. Can you see? It has not gotten back to that place after it. So that's an example of what? Of a bullish order block. That's an example of a what? Of a bullish order block. Now, there's also what we call a bearish order block. The bearish order block, which is the second type, is a what? Is a supply zone. It's an example of supply zone. The bearish order block. So bearish order block. So this bearish order block is also an example of what? Of supply zone. It's an what? Supply zone. What do we do from there? We sell or short. We sell or short from that particular place. That's what bearish order block is for. We sell or short from that particular place. Now, what does bearish order block? The color of this bearish order block is green. It's a green candle. It's a green candle. So what type of green candle? The green candle before the impulsive red candles that did what? That did break of structure. The last green candle. The last green candle that before the impulsive red candles that did what? Break of structure. Now let me show you an example. Look at this AVAX now. These are all my previous trades that I'm showing you. Now look at this AVAX. You see that this AVAX, let me check it. Can you see that this is a what? These are impulsive red candles, right? These are impulsive red candles. And this red candle actually did a break of structure. This was the previous low. Look at the previous low before. This is the previous low. Like the market is dropping. This was the previous drop before the market now come and now drop this much. So once you see something like this, that's an impulsive red candles. So there's already a break of structure already. So as there's already a break of structure, just come and carry the last green candle before the impulsive red candles that did break of structure. So can you see? You see that this is the large green candle before the impulsive moves of red candles that did break of structure. So what happened? Let's trace that rectangle that I drew. Can you see that the market came back to that place and the market came down? Do you understand? So the market came to that place, came down before it now was later reverse and what? But you see that the market played out a little bit before it went another way. So that's that about what? Bearish order block. So not only that, before you can use that, we have a lot of other blocks. You can see as many other blocks as possible. But which one will play out? There are some criteria that you need to consider before you can use this particular other blocks. Do you understand? Not all the other blocks that you are seeing that are actually what? That are actually useful. You understand? Now look at this particular one. Look at this place. You can see that the market was falling in this place. But what can you see? You can see that there's an impulsive red candle here that did what? Break of structure, because it broke it to the extent that we don't have any lower place again. So you carried the last green candle before those impulsive move. You can see that this is the last green candle here. This particular green candle. But did the market respect it? The market was coming. The market touched the place. You do as if you want to respect, but it didn't respect it. The market went back up. Do you understand? Why doesn't it hold? There are some criteria you must consider before you can say this particular order block is tradable and which one is not tradable. We'll get there when we get to other blocks when we get there in proper. Now look at this one. This particular trade now, you can see that there is a what? A break of structure here too. You can see there's a break of this was the lowest before, but now we have that this one has gone down more than this one. So this green candle before the break of structure is an order block. And what type of order block? Bearish order block. You see that the market tapped into that place and the market came down. Do you understand? You see that the market came down very well. So that's that about what? Other blocks. So that's that about other blocks. So that's that about other blocks. So apart from other blocks, apart from resistance, what other places are places of liquidity? Places of demand and supply. There are also places of demand and supply that I've listed already. Another one is fib retracement levels. The fib retracement levels. I've taught you this fib retracement before in the past. So there are also what areas of what supply and demand. So fib retracement. So fib retracement levels. There are two types of fib retracement levels. We have the premium and the discount. We have the premium and the discount. Now, this premium is also called the supply zone, while this discount is referred to as what? The demand zone. That is, it now means that what we sell at premium and what we buy at what? At discount. Of course, if you go to the market, you'll be asking for the seller to give you what? To give you discount on what you buy. Do you understand? So discount. Every seller buyer buyers want to buy at a discount price. If so, they are selling toothpaste for 300. If toothpaste is sold for 300 naira and a company is assuring you that you want to be selling it for what? For 150, but just because of maybe they are just opening. So new user bonus discounts like that. You want to buy, a lot of people want to buy that thing. So that's what can also be referred to as what? Like discount. Everybody wants to buy there. Do you understand? So buy is discount. Discount levels are for buys or for longing the market. Do you understand? Hello, can you still see my screen? Can you still see my screen? I want someone to stop. Yes. Everybody still see my screen? So let's continue. Sorry, my phone is low. So when we say discount, So we are willing to buy at discount. So you long the market, or you buy at discount levels and you sell at premium levels. All these things are just terminologies. It's still what I taught you before about the fib retracement levels. I said we have two types of fib retracement levels, right? The where you sell from and where you buy from. So the where you sell from is refers to as the premium level. Where you buy from is refers to as the discount level. Now, what differentiates them is how you draw them. So if I want to draw for premium, which is for short, then it means that from the trend will be a downtrend, right? And if the trend is in a downtrend, I will start from from top, that is the highest swing point, to bottom, which is the lowest swing point. You understand? So that's for premium or short. Now let's go and look at example in our chart. So let's check this near. I think I did something on that. So look at this near now. Look at this near. Let me just use this as an example for us. Now look at this. You see that the market was just going up, right? The market was just going up, and you want to catch the trend. So you want to enter the market and enjoy the uptrend. What you just do is that the market is going up, right? So that means we are in uptrend. So what type of fib retracement are you using? Discount level. You are using the discount level. So you carry your fib retracement to, then you carry it from the lowest swing. This was the lowest swing. This is the lowest point, right? So then you click on, then you now drag it up to the highest. So then I said you should consider 0.618. This is 0.618 and 0.706. So this is 0.618. This is where you place your entry for you to long the market. Then this is 0.708. You just place your stop loss slightly below that is 0.78. That's how I told you that they trade Fibonacci retracement. Now, I think I've used it before. I'm trying to look at it. If you want to trade this particular one now, if you want to trade this one, where the market has gone down so well, what you do, you place your fib retracement here. This is the highest swing. So you now draw it down. You start from top, then you draw it down to bottom. Do you understand? So you now trace it. So you see that this is the so look at it, 0.61. I say that's where you enter the market from. So the market has come down. You want to short the market too. You don't just short the market and you wait for the market to come and meet you. See that the market tap this place, but the market did not get to. I say you place your stop loss slightly above the 0.708. So the market is you are still in condition. You understand? You see that the market later came down. Do you understand? But it didn't come down the way we actually wanted it to come down. So it happens. Why? Because it's actually targeting this this particular order block here. So later, subsequently, you know which one you should use. Is it the fig retracement? Is it the support and resistance that you should use to trade? Is it what order block that you need to trade? You don't consider all these ones. It's not that it's an option. There is a strategy, there is a formula. Your strategy will tell you that, okay, when you combine this one with this one with this one, then you should use it to trade the market. Do you understand? So that's that about that. So we use fig retracement tools too for our supply and demand zone. Another type of supply and demand zone that we have are liquidity graphs. There are various areas of liquidity graphs. And if I say I should be telling you all of it and should be explaining it, this video will actually be lengthy. But I want you to get the theory very well so that when we are diving into the practical and I'm showing you as every chart unfolds, you are going to be able to understand it better. So when we say the liquidity points, there are various areas of liquidity points. We have like buy side liquidity, we have sell side liquidity, we have internal liquidity, we have external liquidity. All these places are what area of supply and demand zones where you can buy or sell from. Another thing, another liquidity, supply and demand zones, which is the last, is actually the liquidity void area. That is area that actually are areas that are devoid of liquidity, area that needs liquidity. When we are saying liquidity, it means where the money is. When we are mentioning liquidity, it means where money is. And all these zigzag movement of the market is actually looking for what? Liquidity. Because the liquidity refers to as like the fuel of the market. What is propelling the market is what is referred to as what? Liquidity. So that's that about that. If you have any question, I'm going to open the proof up for us so that we can ask our questions. Then when we are considering liquidity voids, it also refers to as what? Fair value gaps. So when we say liquidity void, that is area that is devoid of liquidity, that there is no wick or there is no retest in that place. I'm going to make a special video so that I will now explain what liquidity void is, what is liquidity, types of liquidity, explaining different types of liquidity. Do you understand? So that's that about that. So thank you very much, everyone. See you in our next class.